Welcome, everybody. We are live here at Miami Citywide for Future Proof Festival. I am here with Mark Gatto, co-CEO of CION Investment Group. First, Mark, thanks for coming on the show.
Co-host of the Advisor Lab
Co-host
too.
of the Advisor Lab too, of course.
Give me some credit
That's
there,
true.
right?
We can't attribute all the downloads to me. Mark, we've seen a lot, and you've been running this company out going back almost 2 decades, really.
Yeah.
And obviously, democratization of alternatives and just a plethora of products and strategies have come and gone in that time. But now we're seeing this transformation in the way the business has grown. It was something where when you and Michael, your partner, Reisner, started, was very early days. Probably the first thing I wanted to ask you was, as you've seen it transform, what are some of the big takeaways that you've decided to incorporate into how you're building the business moving forward from what you learned over the first almost 2 decades now?
There's been tremendous growth. When we started this business, I don't think most advisors knew what an alternative investment was. Right? And you fast forward to today, and you have the likes of KKR, Blackstone, BlackRock, Apollo, you name it. Every big brand in our business is all in on alternative investments for the private wealth channel. So there's been just a tremendous amount of growth. It's something great for me to see, right? Because when we were doing this early days, it was very difficult sell. So I think it's a good thing. I think that it lends a lot of credibility to what we've been doing over the years. It lets people know that this is a real asset class, this is a real way to invest, and advisors and their clients need access to well thought out alternative investments. And fortunately, we have structures today that lend themselves to the individual investor, and they can get what I will say is thoughtful access to relevant investment strategies. I do think there's been a lot of product that's been pushed through the channel. I think a lot of firms maybe think that the private wealth channel is perhaps a little less sophisticated, and they think they can just replicate a strategy that they've been doing for institutional clients and put it in the private wealth channel. And that's where I see some issues developing in our channel. We don't think this is a industry where there should be a unlimited amount of product out there for investors. We think that products for the individual investor, for the private wealth channel, they need to be very thoughtful. And I think that's where we excel. That's where we really take pride in what we do as an organization. As one of the first firms to be in the private wealth channel, to offer accessible alternative investments to individual investors, we take great pride in the fact that we're very thoughtful. We're not quick to just come out and push any product. Mm-hmm. And that's probably one of the most important things that can happen right now. I think advisors really need to take a step back and sort of focus on, okay, who's the franchise I'm partnering with here? How do I fit within their business model? And are they producing high quality product that can endure the test of time? Right? And I say that because every strategy is not appropriate for this channel.
So when you say that, let's peel that back a little bit, right? Because we know the big names out there, and they've all started with, maybe they were real estate, maybe they were leveraged buyout, maybe they were private equity, and now they've all bolted on these different. And you say, well, I can check the box. It's a great manager. I can do everything with them. And it sounds like you and your partner took an approach that, no, you're not. Everyone's not good at everything. And you don't want to have all your eggs with one sponsor, because we're seeing it today, not to name names, but that can be a risk for the home office, for the advisor. Were you guys thinking about that, or was it more of, I mean, because you're one of the few firms where you really don't have institutional business, right?
Zero.
You bought this company and started it with advisors as your clients. So I guess the question is twofold. Like, when you built it, did you think about having one manager with lots of strategies is not the future? Why? And then two, like, why do you think your lens through We Go Advisor first makes such a difference when you're talking to home offices?
Sure, I think. Well, first and foremost, we're open source, open architecture, and we think that is a very powerful way to approach the market.
Right.
There are some great firms in this business. I'm not going to disparage them, but the bottom line is no one firm is really good at everything, right? Yes, they're trying to grow their platforms, they're public companies, they need to create revenue, they need to diversify their revenue streams. You don't really take franchise risk because we're going out and we're identifying who we think the best manager is for the strategy that we create, right? Again, you said it, we're built on the backs of advisors. We don't have institutional clients. So everything we do is about the advisor and their particular client, the individual investor. So we need to make products that are appropriate for them. We don't do what others do and kind of create an institutional product and say we got this amazing track record on this institutional product and then bring it downstream, so to speak, and make the bad assumption that it's going to be appropriate for not only the individual investor, but just for the business in general. It's a unique business. We've done business with and partnerships with some of the biggest and best managers in their respective asset classes. And when we first started, they didn't know how to manage a publicly registered daily NAV. Capital comes in every day. 30 days later or a quarter later, you're giving distributions. They had no clue. They're accustomed to a drawdown structure, right? Where you bring the money in when the investments are available. Your clock starts ticking when you make that investment. There's a lot of compliance around these products that if you don't get right, could be disastrous. There's a lot of plumbing that has to be set up that if you don't get right, could get you off to a bad start. Again, we've been doing this for almost 20 years. As partners, Michael and I, more than that, as owners of a business. So we understand all that. So whenever we're creating a product, we want to make sure that it's going to be successful. So we think about things like being highly diversified, right? We don't want to have high conviction strategies. We just don't think that it's appropriate for this channel. You want to be able to be dynamic, right? Where you can allocate capital to different areas within a certain asset class because, quite frankly, there are times when an asset class that you're promoting isn't the best to invest in, right? But if you're saying, hey, we do this, right, and this doesn't work, well, what are you doing with that money when it's coming in every day, right? You have to put it to work somewhere. You're either putting it to work where the asset class isn't that favorable, or you're style drifting and getting involved in investments that you don't do that well. So being thoughtful about those things is really important, right? Every advisor comes. I'm sure you're on the road and you're talking to advisors. And the first thing out of their mouth is, "Okay, what's the track record?" And I say, you know what? Absolutely, you have to ask about the track record. But the problem is, everybody stops there, right? They want to know the track record. They want to know how much your AUM is, how long you've been doing it for. And these are obvious questions, right? You should ask those questions, but everything stops there. They don't really focus on the strategy and how does it work within this particular wrapper, and how do you handle things like liquidity, and what's going to happen if you get a certain level of tenures. How are you going to handle it? How are you mitigating risk? They don't really focus on that. How is your capital raise structured, right? Do you have high quality distribution that has the appropriate relationships and network to raise meaningful capital, right? You don't want to get into a fund and all of a sudden the capital raise slows down because they've exhausted all their relationships and maybe it's not as attractive as they told you it was, or perhaps your capital raise is focused and very narrow, and it's maybe large, but it comes from a small group of investors.
You say something there about capital raise, right? And capital raise and where you get it is a big moat to help play defense in times of distress. When you and Michael were building this, and you're thinking about the relationship side of it, you need a sales team that is going to work diligently with the advisors, the home offices, keep them abreast. Did you guys think about the support that you're going to provide to the advisor community? Do you think you do it better than your competitors? Do you think you do it differently? How much did you put into that?
I think we do it better, probably because of what I said before, because that is our only client. Right? Our guys are not worried about getting some major institutional allocation. They're not worried about going to Davos or whatever the case may be. Certainly, Michael and I aren't worried about that. We're worried about being at these events, right? We're worried about making sure we have a strong relationship with the appropriate people at Morgan, Wells, and UBS, and certain RIA platforms and the IVD channel. Like, that's where our bread is buttered, right? So I think we do a better job because it's much more important to us. And I also think the fact that we've been in this business for so many years is an advantage. We understand their businesses or their practices and what's going to help them achieve success. So I think that's important. I think that being able to communicate, especially when markets have been disrupted, is the most important thing. We weren't rushing to make investments because we didn't have the type of deal flow that we needed to put the money to work, right? There's this term adverse selection, right? You start raising a lot of capital in this channel. Does the manager have the capabilities to deploy it? Can they see enough deal flow? Does anybody even talk about that,
right? You bring up that point, right? You guys have partnered with some of the biggest names in the space. 18, 19 years. You probably could have 10 or 12 products right now. What are the ones you passed on? Why?
I wouldn't say it's a specific asset class that we passed on, but we passed on opportunities where we didn't think the manager was high quality enough. We didn't think they could, even if they were high quality in what they were doing, we didn't think they could originate enough assets. We didn't think the supply was out there. Like, we feel like when we start a business, when we start a product, we put it on the whiteboard. Our intention is to raise a significant amount of capital, right? And we have the belief that we can do it, because I think we're pretty good at what we do. And I like to think that when we sort of advocate for something and we do it, advisors trust us, right? So we expect to raise a lot of money. So we could, in good conscience, take any particular strategy and say, hey, let's go do this. It's the hot topic right now. It's the flavor of the month. And then realize, well, the manager can't really source it as abundantly as we thought, or there isn't that significant of an opportunity. And we want to make sure when we develop and launch a product that we can advocate for it in a way that allows all of our advisors and their clients to participate, right? So doing a narrowly focused product isn't that appealing to us, right? So we want to build complementary products that make sense for a well-diversified portfolio. Because again, if you want to create a large fund that can invest through all different cycles and mitigate risk for your investor, you need to be diversified. But you can say that, right? Diversification, but can you deliver that?
So that's talk about structure a little more, right? Because that's a big topic. But now it seems like everyone wants to say, now's the day of record. Let's see how these operate.
Sure.
But do you feel like something's being lost there? Like, these strategies were meant to be semi-liquid, and provide some transparency, but yet the news, with the biggest BDC or one of them out there, making an asset sale. Do you think that's being reflected the right way? Do you think the products are working the way, even if they do start to gate Do you think they're working the way they were designed?
Yep.
And do you think that it's going to be something in the end where the industry's stronger for it?
Sure. Well, to coin a very politicalized phrase, there's a lot of misinformation out there, disinformation out there. And the example that you're talking about I think is very specific, right? It's not something that permeates the industry. And that's the problem with the media today. They're being very general about it. They're using generalized terms. And unfortunately, the consumer of that information doesn't always know how to dissect it, right? And that's our job, right? That's your job. That's one thing we preach all the time. We have to be really good at educating advisors and their clients. And that's probably one of the biggest priorities. Obviously, performance is the most important priority. But after that is the education, and that is sort of in the same bucket as communication, right? But I think we're in a really good place, again, because of the way we've built these assets and how we use diversification. But ultimately, the semi-liquid nature of these funds is purposeful. It's so that we can match capital to the investments, right? These are typically longer dated private investments that we hold to maturity. We're not trading them. We're not completely taking advantage of technical dislocation and trying to buy low, sell high. We're underwriting these businesses and we are intending to hold them long term. So the limitation on liquidity is there purposefully, and I believe that it's one of the value propositions that we provide. Far too often, individual investors, they panic and they sell at the wrong time. So I believe they're working the way they should work, and people are exaggerating the impact of a proration, right? If in one quarter, if you go above the 5% by 20%,
right,
doesn't mean you've been locked out, right? You're still getting 80% of your request or whatever the percentage is, and you have the same opportunity to do it the next quarter and the quarter after that, so you're not locked out, unlike a traditional alternative.
Yeah.
Right? So if you're in a traditional alternative and you want to take advantage of the liquidity premium or the scarcity premium or the manager quality premium that they can find these great deals, and you do so in a traditional alt, well, you could certainly be stuck in that investment for a very, very long time, or see it when you need it the least,
yep,
right?
Yep.
So here you have an opportunity where it's a balance between those two, and you're getting the opportunity to take advantage of the liquidity, scarcity, manager, know-how, yet you still have access to your capital. And in investing in general, there are always winners and losers, right? There's always better investors and lesser investors, and these types of markets create opportunity. And if you're a high-quality outfit and you have discipline, and you have the ability to originate and underwrite appropriately, and you have capital to invest, sure, this is a great market.
Well, this has been great, Mark. Let's do this more often.
Absolutely.
Enjoy the rest of the conference.
All right, brother.
All right.
Thank you.
This video is for informational purposes only and should not be considered or relied upon as investment advice. It may not be copied, quoted, or referenced without CION Investments' prior written consent. Do not rely upon any opinions, predictions, or forward-looking statements contained herein. The views expressed do not constitute an offer to sell or a solicitation to purchase securities, nor do they constitute the endorsement of a particular asset class or investment strategy. Neither CION Investments nor its affiliates and/or subsidiaries warrant its completeness or accuracy. Certain information contained in this video may constitute forward-looking statements that may be inherently unreliable, and actual events or results may differ materially from those reflected or contemplated herein. CION Investments expressly disclaims any obligation or undertaking to update or revise any information included herein. The views expressed by the guests or participants are their own and do not necessarily reflect the views of CION Investments, LLC, or any of its subsidiaries, officers, or staff. Please be aware of the real risk of loss in following any investment strategy. No investment strategy or asset class referenced herein is intended to be construed as investment advice. You should make an independent, informed decision regarding any investments or strategies only after reviewing all relevant offering or disclosure documentation with your financial professional, and after considering your objectives, risk tolerance, and best interest before making any investment in any financial product. Registered personnel should review any business development initiatives addressed herein with their respective compliance and legal departments. Coverage of such topics should not be construed as compliance or legal advice. It is at the discretion of each respective firm if such practices are consistent with firm policies and procedures.